Hey, Dinarland Ninja here. I'm gonna read an article from the Financial Times called Deutsche Bank Grapples with Capital Raising to Pay for Cuts. It says, with Deutsche Bank's share price languishing close to a record low after talks to merge with Commerzbank collapsed this spring, Germany's biggest bank is going through one of the toughest moments in its 149-year history. There are now serious questions over whether Deutsche will need to raise billions of euros for a further restructuring and, if so, how it will raise the money, hemmed in by its shrunken market capitalization and increasingly frustrated investors. Top executives are doggedly working on fresh strategic overhaul, which Chief Executive Christian Sewing has promised will involve tough cutbacks to its ailing investment bank after it slumped to a loss over the past 6 months. However, investors may have to wait until its second quarter results in late July to hear what Mr. Sewing decides. And even then, analysts are skeptical that the cutbacks will solve the core problems confronting the lender. Meanwhile, Deutsche Bank is trying to keep a low profile. Mr. Sewing canceled a keynote address at the bank's own financial conference in New York last month as new problems keep sprouting up. Last week, Fitch Ratings downgraded Deutsche's credit rating to triple B, only 2 notches above junk, warning that a further restructuring would be difficult to implement while the bank is squeezed by negative interest rates and continued erosion of its market share in investment banking. The Financial Times has spoken to more than a dozen banking executives, investors, regulators, and analysts to assess why Deutsche's restructuring plan is taking so long, what the major obstacles are, and if the stretch bank can afford the extra costs. Sticky costs. Mr. Sewing has hinted that the next round of swinging cuts will focus on the lender's U.S. equities and rates trading businesses because they are detached from its other operations and cost hundreds of millions to run each year. Kiana Buhausen, analyst at J.P. Morgan Chase, estimates that Deutsche's global equities business alone loses $600 million annually on a pre-tax basis. Yet current and former senior Deutsche managers warn that even a complete wind down of those units would not immediately improve profitability and could even push it into another annual loss, breaking Mr. Sewing's pledge to make a profit this year. Deutsche is acting within tight constraints, and strategic optionality appears limited given the depressed profitability. It cannot afford a radical strategy change at the moment on a standalone basis, said Danielle Brupheimer, analyst at UBS. Shrinkage of the investment bank could rapidly push the bank into loss-making territory for a prolonged time. A former senior executive at Deutsche said that when exploring the closure of the rates business in the past, management realized such a step was not straightforward because even a complete closure would only get rid of a fraction of its costs. We realized that we could maybe fire 18 of the 23 guys on the trading floor, this person said. However, some will have to stay in order to oversee a rundown of legacy positions. The longevity of the swaps and derivatives also made it impossible to shut down the related IT systems monitoring them. Mr. Abehusen of J.P. Morgan wrote in a report, the majority of cost savings will have to come from infrastructure and back office staffing. Deutsche's investment bank employs the same number of staff as the whole of Goldman Sachs, even though the Wall Street Bank makes 1.5 times the revenue of its German peer, he said. Overall, operating costs in the corporate and investment banking unit absorbed up to 95% of revenues last year. Capital issue. Where to swing the axe is only half of the challenge facing Mr. Sewing. He also has come up with a way to fund the restructuring. The risks they face now, if they do attempt meaningful change at the investment bank, is that they might have to do another capital increase, said a second former senior Deutsche executive. Stuart Graham, analyst at Autonomous, said restructuring costs in investment banks were usually 100 to 150% of the targeted cost savings. Several people with the internal discussions said a full cleanup of the investment bank could cost at least $4 billion, with about half that sum to be booked in its accounts immediately, including severance pay for the staff. Deutsche's bombed-out share price makes it unappealing to cover this by raising fresh equity, a move likely to enrage investors. The shares this month dipped below 6 for the first time, and shareholders are fatigued after raising the capital to $30 billion since 2010, at least one by each of the 4 chief executives. That amount is more than double its current market capitalization of less than $13 billion. The shareholders I represent totally disapprove of the idea of yet another capital increase, said Klaus Nieding, vice president of German Shareholders Protection Association, a lobby group for retail investors. Shareholders have granted Deutsche permission for 3 different ways of raising capital. Taking together, the bank has the unfettered right to issue 1.2 billion new shares, or 58% of its current share count. Any more would require an extraordinary meeting to seek investors' approval, an unappetizing prospect. Assuming Deutsche offers a 32% discount on the share price, as it did to entice wary investors in 2017, the bank could sell about $4 billion in equity and $1 billion in convertible bonds, FT calculations show. And that's all for now. Thanks for tuning in.